Hi there, welcome to Kneppy Invest. When I first started investing, I was a value investor. I looked for companies that were quality companies at good prices, prices I would love to buy the complete company for. Now, probably the biggest question I had and problem I had back then when I started investing is how to define a quality company. And I think that could have been my biggest mistake. These days, when I look for value, I don't really try to determine whether the company is high quality or not. I prefer to own high quality companies for the long time or longer term. But if I do see some value in a low quality company, I would consider taking a more short to medium term position in that company if the chart is breaking out or almost about to break out. And that might be true for the company I'll be focusing in today's video, Wagners. The chart looks interesting. What's starting to look interesting? And then when I had a look at this company's half year results, I thought, is this company cheap or good value at current prices? Hence today's video. Now, before I go any further, Wagners is like a construction materials developer, manufacturer. They also do cement, new age cement. I'm not sure if that's the right word, new age, but environmentally friendly cement. Although I don't think that division is doing all that well right now. Wagner's listed on the ASX in December 2017, so it's only been around for about 6.5 years and at a share price of 99 cents. Share price is struggling to get above $1. We'll have a look at the chart at the end of this video. The market cap of this company is 185 million. So I knew the market cap of this company, and then I went to page 4 of the company's presentation, and I just saw some of these numbers here, and I went, this company could be interesting, particularly the changes in some of these metrics from last year. And in fact, if you look at the title of this little table, strength in core business offset by EFC CFT performance. Now, this is a pretty good quarter for the company. So nice growth in revenue, up 44%. Company has really good gross profits and gross profit margins, 51.9% gross profit margins. In fact, that actually did surprise me. I would have expected the gross margins of this company to be a little bit lower. And I think reasons behind that is because usually for this company, I expect really low profits and really high revenue, which is low margins. But there might be a reason behind that. Operating costs 103 million, but operating EBITDA 34.7 million, operating EBIT 21.1 million. So those two numbers in themselves actually attracted me to Wagners. They had some impairments, some one-offs, which means the statutory EBIT or the reported EBIT was 12.5 million. And then a pretty big drop from statutory EBIT to net profit after tax. So that means either the company paid a massive amount in taxation or the company paid a fair bit of interest. And I'll talk about that later in the video. So it's really this particular table that attracted my interest to Wagners. But then I went through the financial statements and I'll show you the balance sheet and the cash flow statement. And even those two, or things I saw in those two statements, led me to go further down the path of determining whether or not Wagners is a cheap company at this point in time. So I'm going to skip right past the profit loss statement because most of the numbers or the only relevant stuff, in my opinion, apart maybe from the expenses, in the profit loss statement were actually showcased in that previous table. So let's have a look at the balance sheet. So some things I'm looking for here are cash, debt, and changes in working capital, and a few other small things as well. But the company has about $30.5 million of cash, and that was a fairly big increase from last year, which is $11.4 million. And you also notice the company has a fair bit of borrowings. Last year, this company had over $100 million of debt. That has been decreased to about 86 million. So it does seem like the company has paid down the debt in the past year. The other thing I look for here, which means, by the way, the enterprise value of this company is 241 million. And this is important when you do calculate some valuation metrics. And some of my favorite valuation metrics use enterprise value, not the market cap. So the other thing to take note here is working capital changes. You could go to note 12, which is not mentioned here. It's mentioned in the cash flow statement, which is a reconciliation of profit to the operating cash flow. And they do go through the changes in working capital in that particular note. But you can calculate it just from here. Do a quick calculation. Just look at the changes in trade and other receivables, inventories, and trade and other payables. And if you do that quickly, you can see a massive drop in trade and other receivables. Now, that's going to be beneficial to the operating cash flow, which we'll look in the next slide. And I just calculated working capital changes were negative 19, which is beneficial, again, beneficial for the cash flow. So let's have a look at the cash flow statement right now. So remember, changes in working capital were about 19 million or 20 million roughly. And if you didn't realize that, if you just went in looking at this company's operating cash flow blindly, you'd go, wow, what an absolutely amazing half year for this company. Operating cash flow of 46.1 million. Massive increase from last year, 12.7 million. But even if you take into account changes in working capital, which would bring that down to 27 million, and even if you decrease the payments for property, plant, and equipment, or the capital expenditure, this company still had free cash flow of about 14, 15 million. But if you don't take into account changes in working capital, operating cash flow 46 million, and free cash flow 39.5 million. That's pretty high for a company with a market cap of 185 million, enterprise value with 241 million. And don't forget, this is in one half. But you do have to be aware that there was beneficial changes in working capital that did prop up this operating cash flow and free cash flow of Wagners in the past half year. Now let's have a look at the financial history of this company, focusing in this particular slide on the profit and gross margins. Now the first thing you might notice is the gross margins, and this is through FinChat. So the gross margins through FinChat are a little bit lower than the gross margins the company provided. However, this is on an annual basis, and those numbers provided the company were the half-year numbers, but there's still a big difference. So there is potential that the gross margins for the second half of the year are going to be lower, and maybe this company is a little bit more seasonal. So there's definitely the possibility of that. I tried to go to FinChat just to see or break down the gross margins by half year, but for some reason it wouldn't do it. But anyway, it's not really the number that I'm looking for here. It's the trend. And that is true not only in revenue, it is also true for gross margins. Now, I would prefer revenue per share because that takes into account any capital raisings. And if the company has made any acquisitions through capital raisings, that takes that into account. But the main thing here is revenue has been increasing over the past 5 years after looking like it was flat for a period of time. In fact, from 2015 to 2020, revenue sideways, although 2015 was a much better year than 2016. Now, you also might be saying, how am I getting 2015 and 16 numbers if this company listed in 2017? When a company lists on the ASX, they do provide the last 2 or 3 years of financial statements. So you can definitely see the numbers this company produced in 2015 or 16 just by looking at this company's prospectus or the financial statements the company releases alongside the prospectus. So revenue increasing through time. In fact, FinChat has provided some CAGR here, which is really cool. So CAGR of 8.96% per year over the past 10 years. And if it was only past 9 years, is it 10 years? No, 8 years. If it was only past, say, the last 1, 2, 3, 4, 5, 6, 7, 8, it'd probably be higher because there was a decrease in revenue from 2015 and 16. So we do have revenue increasing through time, and that is important. I should also mention the last column here is the last 12 months, or I like to call it trailing 12 months. So it's the last 12 months, the last half of 2023 and the first half of 2024. Now, onto gross margins. So even though the numbers are a little bit different than what the company provided, the main thing here is the trend. And the trend was not Wagner's friend from 2015 through to 2020. In fact, the trend looked absolutely horrible. Gross margins falling from 60% to 38.6%. But it does look like gross margins have found a floor. Hopefully, for Wagner's sake, gross margins don't fall any lower than 38% because that could be nervous times for shareholders. But the main thing here is gross margins have found a floor, and I'd love to see gross margins starting to rise And if this company can increase the revenue, increase the gross margins, I think this company is looking cheap at current prices. But you have to put a lot of faith in management that they can achieve both of those moving forward. But if you like to throw the dice, if you like to take a risk and just hope that management are able to achieve that, yeah, I think Wagners is looking cheap just based off these two things. Now to the question, is Wagners cheap? So I just calculated a few valuation metrics, three of my favorite metrics: EV to EBIT, EV to free cash flow, and free cash flow yield. Now, do be a little bit wary when you do look at the EV to free cash flow and the free cash flow yield for Wagners, because that does include that half year where the free cash flow probably was benefited from changes in working capital. Now, to calculate free cash flow and EBIT, I did use trailing 12 months. So also included the last half of financial year 23. And to be fair with you, those numbers, EBIT and free cash flow for Wagners, were not that high in that particular half year. And when I looked at the full year results and compared it to the half year results, there was a skew between the first half and the second half. So there is a possibility there is a bit of seasonality when it comes to Wagners. But let's have a look at some of these numbers. EV to EBIT, 10.1. That's pretty good. I'd probably prefer that to be below 10. And this is why I do prefer enterprise value over market cap. So if you did calculate the price to EBIT, you definitely would have had that below 10. EV to free cash flow, 5.5. That is definitely on the low side. And if I wasn't a little bit hesitant in regards to free cash flow or using the free cash flow numbers for this company in the last half year, I would say to get an EV to free cash flow 5.5, that would be an indication that this company is cheap. But you don't stop the story there, and this will become evident when we look at the next slide. And the free cash flow yield, 23%. Now, there is research that suggests that free cash flow yield is a really good determinant whether a company is going to outperform the market. So companies with high free cash flow yields tend to outperform the market, particularly compared to companies with low free cash flow yield. And maybe that's just a study done by some value investors trying to justify their investing strategy. I don't know. But a free cash flow yield of 23% does seem quite high. And just remember, that's on the back of this company having beneficial changes in working capital that propped up their free cash flow in the past half year. Now, on to something that's very important when determining whether a company is good value. Valuation metrics on itself don't tell us the absolute complete story. You need to know the history of these valuation metrics. So let's have a look at the EV/EBIT history of this company since they listed on the ASX. Yeah, so this is the EV/EBIT history of Wagners going back to December 2017. So what we're looking for here, or comparing here, is the EV/EBIT right now of Wagners compared to historical numbers. And what we're looking for here is whether the number right now of EV to EBIT is lower than what you usually expect. Now, the EV/EBIT that is used or calculated by FinChat is a little bit different from mine, a little bit higher than what I calculated. And the reason behind that is I believe the enterprise value might be a little bit higher, or maybe the EBIT is a little bit lower, but it shouldn't be that much difference. So 12.3 they have, and I had, was it 10.1 or so. But the main thing here is not the number, the last number. It's just making sure whatever or however you calculate this particular metric, you're consistent through time. So I'm assuming that FinChat is consistent through time, which means 12.3 is the lowest EV to EBIT this company has experienced or seen since it listed on the ASX. In fact, the previous lowest was about 14 and 15 back in 2019. So just based off this particular graph, you could definitely argue that Wagners is cheap or good value at current prices. But it doesn't mean the share price is suddenly going to zoom higher, because maybe it is cheap for a reason. Maybe the market doesn't really like this company, doesn't think this company is going to perform over the next few years, and it's bringing the share price down because of those concerns. So let's have a look at the chart for this company to see if the company's share price is in a downtrend. First of all, let's have a look at the weekly chart. And this goes back to when the company listed on the ASX, by the way. And in fact, the first, say, 6 months that this company was listed, things were looking good for the company and the shareholders. In fact, the share price went to a high of almost $5 in late 2018. So share price now is struggling to get above one. So the share price has dropped 75% in the last 6 years or so. And then the share price moved into a long-term downtrend. In fact, the share price went from $5 all the way down to about 60 cents in or during the COVID-19 financial panic. And that was almost the low, all-time low, historical low for this company, but that was not the low. Share price then had that V-shaped recovery, went all the way back up to about $2.50, and then the share price went back into a long-term downtrend. And when I say long-term, it went from reached the peak in middle of 2021 and found the low in the middle of 2023. So 2-year downtrend, and that low was just above 50 cents in the beginning of 2023. So we're talking about 1 year ago. So in the past year, the share price of this company has increased by 100% from about 50 cents to almost $1. So let's have a look at the daily chart. And this is actually when things become a little bit more interesting for Wagners. Yeah, so this is the daily chart, and this is from the start of 2020, so just 23. I want to include where the share price did reach its low of about 50 cents. In fact, it was about 52 cents. And in fact, it was in March of 2023. So we are talking about 1 year ago. And the share price was in a downtrend at that point in time. But it does look like that downtrend came to an end. Sentiment started to shift from negative to about neutral during the second half of 2023. There was a little bit of excitement in this company in August, September. The share price looked like it was trying to break out, but that breakout failed. In fact, I was trading Wagners at that point in time. I took a position and then sold out of the position when I thought the breakout was losing steam. And really, since then, the share price has gone sideways. Now, there was a little bit of a dip in December. And in fact, if I saw the share price fall below 80 cents right now, I think I would become interested in taking a position just based off valuation. But that little bit of a dip didn't last very long. Share price popped up straight back up to about $1. And since then, share price is just going sideways, creeping slowly higher right now. So if you just look at the last 3 weeks, just grinding higher day after day after day, and it is still struggling to get above $1. And I probably would say if the share price gets above, let's say $1.05, that could be good times moving forward for Wagners and its shareholders, particularly if the company releases some good financial news to the market. So the question is whether or not Wagners is good value. Now, I wouldn't say Wagners is screaming good value. I wouldn't say it's absolutely obvious, but I do think there are arguments to suggest that Wagners is good value. And just based on the chart, I am liking what I see. Nice consolidation period. And all this company has to do, all that I need to see, is one good financial announcement from the company, maybe a profit upgrade. And if I see that profit upgrade, I do think there is potential Wagners will break out. Now, more than likely that won't happen, but it's no loss to put this company on your watch list and just wait and see if the company does release that announcement. And if not, just have a look at their full year results that they will release in August. And to be honest with you, August is only 4 months away, and potentially the share price will keep on grinding slowly higher, or maybe just go sideways. So I think you can be patient with this company moving forward. I don't think the share price is going to take off for no reason. I think there would have to be a reason if we see the share price break out. But I'll still will be watching the fortunes of this company over the next few months. Anyway, that's all I have for this video. Is Wagners good value? What are your thoughts? I'd love to hear from any shareholders of this company, a Toowoomba-based company, by the way. So leave your thoughts in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.